All right, let's get right into it. What if everything you see about Bitcoin's price day to day, the crazy ups, the scary downs, all those screaming headlines, what if it's all just noise? What if it's a giant distraction designed to hide a much, much bigger game being played right in front of us? Well, that's the wild theory we're digging into today.
And that quote, it's really the whole key here. The theory we're exploring suggests that if you're just watching the daily price chart, it's kind of like you're watching the ball in a football game, but you're completely missing the plays being called and the strategy unfolding on the field. The stakes, according to this idea, are way higher than just your daily profit and loss.
And that is the million-dollar question, isn't it? Well, this theory claims the real game is this quiet, strategic fight to control what could be the world's next reserve asset. The bedrock money that everything else is measured against. To get how it's supposedly being played, though, we first have to understand why a new game is even on the table.
And that brings us right here to the current financial system. You see, this whole theory, it's all built on one core idea, that the foundation of our modern economy is starting to show some really deep structural cracks.
The key word here, you gotta remember, is trust. Fiat money, like the US dollar or the euro, it only has value because all of us collectively agree and believe that it does. So, what happens when the very governments that issue it start doing things that chip away at that trust?
And this, right here, is what the theory points to as the core problem. When governments run into trouble, what's the go-to move? Often, it's just to print more money. But that's not a magic wand. This theory sees it as a kind of silent tax, one that slowly but surely devalues every single dollar in your bank account, making your money buy less and less over time.
And just to put a number on this, take a look at the US national debt. It's a staggering $37 trillion. That is the sheer scale of the money that's been created and borrowed against the future.
And hey, this is not just a US problem. Over in China, their national debt is clocking in around $17 trillion, so it's a global thing. The argument goes that when the world's biggest economies are built on this mountain of ever-growing debt, the whole system just becomes unstable, and that creates the need for an escape hatch.
So if the old system is supposedly breaking down, what's the solution? Well, this is where Bitcoin enters the story, but not as some speculative, get-rich-quick gamble. No, it's positioned as the potential digital successor to the ultimate store of value in human history, gold.
And this little chart, this is absolutely central to the whole argument. Just look at the supply. Gold is rare, yeah, but we can always theoretically find more of it and mine it. Bitcoin's supply, on the other hand, is absolutely fixed. There will only ever be 21 million. Plus, it's digital, so you can send it across the world in minutes, and anyone can verify the transactions. These are the features that make people say it's a major upgrade to gold for the 21st century.
And that's why you hear this phrase a lot, the hardest money. Because its supply is totally predictable and impossible for any government or bank to change, the argument is that Bitcoin is basically the most sound and robust form of money, ever. That makes it a perfect candidate for a new reserve asset in our digital world.
Okay, now we are getting to the absolute heart of this theory. It suggests that what might be happening with Bitcoin today, it's not new, not at all. In fact, it's a modern rerun of a playbook that was used almost 100 years ago with gold.
So back in the 1930s, the US government supposedly followed this three-step plan. First, it quietly stacked up its gold reserves. Then, and this is the wild part, it passed an executive order that basically made it illegal for regular citizens to own gold, forcing them to sell it to the government. Finally, once it had control of the supply, bam, it jacked up the official price of gold against the dollar.
And here's the direct comparison. The theory is that the exact same playbook is being run today with Bitcoin. Step 1, institutions are quietly buying it up. Step 2, instead of just seizing it, which, let's be honest, is way harder in a digital world, they'll create a massive panic to get people to sell it willingly. And Step 3, the end goal is exactly the same, get control of most of the supply before its price is revalued on a global stage.
So that brings up a massive question. How do they actually get the Bitcoin? The supply is capped, and a ton of it is held by regular, everyday people like you and me. Well, this next part of the playbook is supposedly all about engineering a massive transfer of that asset from the hands of the many into the hands of the few.
Right, so that's the tactical question, isn't it? The big players don't want to buy at the top. The whole point of the game is to get it as cheap as possible. So how on earth do you convince millions of people who believe in this thing to just hand it over at a massive loss?
The weapon of choice, this theory claims, is something you've probably heard of. FUD. Fear, uncertainty, and doubt. It's not about fundamentals. It's a psychological warfare campaign. The goal is just to flood the airwaves with so much negative news and scary stories that even the strongest believers start to second-guess themselves, and they panic sell.
And you can almost picture the headlines, right? The AI bubble is bursting, taking crypto with it. Quantum computers are coming to hack your Bitcoin. Or just constant terrifying warnings about a deep global recession and economic collapse. All of it is designed for one thing: to create maximum fear and get you to sell.
Now here's the kicker. This theory points to data suggesting this quiet accumulation is already happening. While regular investors are reacting to the scary news, big ETFs, major corporations, and even the US government have reportedly been buying, and they've already scooped up over 13% of the total supply.
So at the end of the day, the objective is presented as being brutally simple. Use fear to manufacture a crash. And in the middle of all that chaos, terrified investors will sell their Bitcoin for pennies on the dollar. And the big institutions will be waiting right there to buy it all up.
And this is where the whole theory really comes home to a personal level. Because if this whole scenario plays out, the argument is that every single investor is going to face a critical choice. A choice that isn't defined by the markets, but by your understanding of the game that's being played.
And here are the two paths, laid out plain and simple. You've got path 1, the panic. That's where you react to the fear, you sell low, and you become part of that wealth transfer, on the wrong side. Then there's path 2, the playbook. That's where you understand the game being played, you act with conviction, and you put yourself on the other side of that big trade.
So really, the biggest takeaway from this whole theory is that it wants you to completely reframe how you see a crash. It's not a market failure. It's not the end of Bitcoin. In this version of events, the crash is the most important part of the plan. It is the plan. It's the mechanism that makes the whole transfer of wealth possible.
And that leaves us with one final, very provocative question. This theory, whether you buy it or not, it forces you to think about the possibility of a much bigger game. It suggests that the biggest financial event of our lifetime might not be a random accident, but a deliberate move. And when it's all said and done, the only question that really matters is, who's left holding the asset?